My name is Michael Grandy. I'm a professor at Providence College and teaching a chapter on statement of cash flows. This is chapter 12 from the Brewer book, 7th edition. And the problem we're looking at is on page 595 of that textbook. It's problem 14, and it's Lomax Company. And what I'd like to do is prepare the statement of cash flows, going through all of the steps in looking at the information provided in the chapter. The first part of the problem gives you a comparative balance sheet. They go on to give you some additional information. And then lastly, they give you an income statement. So if we remember how to prepare the statement of cash flows, we have step number 1, where we want to look at the income statement and find some relevant information. Now, let's not forget to put the title on this statement of cash flows. This is Lomax Company. You want to tell the reader of the financial statement the name of the company, the financial statement that they're looking at, and for the time period that they're looking at. So it's Lomax Company. You're going to indicate statement of cash flows. You also want to tell them the time period, and this is for the year ended. They don't exactly tell you the year because they tell this year versus last year, but you want to say for the year. It gives you the time period for the year ended, and we'll say 12/31/16. That's the title. Don't want to lose points because you did not put the title. Very important. So there's obviously 3 sections to the statement of cash flows. The first section is cash flows from operating activities, both in and out. The second section is cash flows from investing activities, both cash flows in, flows out. And then lastly, cash flows from financing activities. So we're going to start with the cash flows from operating activities. I abbreviate. And as I indicated to you, the first step is you want to look at the income statement because we're going to find net income. Pretty easy to find. It's on the income statement. It's the bottom line, isn't it? In this case, the net income is $170,000. Remember, we're using the indirect method for calculating and preparing the statement of cash flows. What that means is that we start with net income, arrived at using the accrual basis method of accounting, and then making various adjustments to arrive at cash flows from operating activities. Okay? So we start with net income, and then we want to make some adjustments. We want to always add back non-cash expenses and subtract non-cash income. The first one that we're looking at is depreciation. So if we look at the income statement, we see a lot of information, but we don't see depreciation expense. It's just not there. What we have to look at is the accumulated depreciation account to see if we can find anything that's relevant there. And what we learned is that, again, we need to look at an account. We need to look at accumulated depreciation. And I'm going to put it right here. I hope you can see it. And we need to build in some of the information that we see that's there. We go to the comparative balance sheet, and we see beginning accumulated depreciation, and that happens to be $755,000. And we see ending accumulated depreciation, and that's $810,000. And we have to ask ourselves, how did we get there? How did we arrive at that number? And we need to be very careful because we need to look at the additional information to see if there were any assets sold. Because as we saw in a previous video, that if an asset is sold, we need to remove the asset, but we also need to remove the accumulated depreciation. So if we look at the additional information that's provided to us in this problem, the bottom of page 595, Item C, it states equipment was sold during the year for $70,000 cash. The equipment had a cost of $130,000 and had $40,000 of accumulated depreciation. What does that mean? Well, when they sold this asset, they removed $40,000 of accumulated depreciation, and that brought the preliminary balance down to $715,000. So now you know an asset was sold and it reduced the accumulated depreciation down to $715,000. Now you can come to the conclusion that there was $95,000 of depreciation expense. Because remember, in order to record depreciation expense, the company recorded a journal entry that was a debit to depreciation expense and a credit to accumulated depreciation. By knowing there was a $95,000 credit in accumulated depreciation, you know there was a debit to depreciation expense. And as we indicated in class, depreciation expense is a non-cash expense. Depreciation is the allocation of an asset over its useful life. It's an allocation. There is no cash impact. Therefore, we want to add depreciation expense back to net income in the amount of $95,000. The other thing we want to do is continue to look at that income statement to see if there are any gains and losses, because gains and losses are also non-cash items. Why? Because the gain or loss is simply the difference between what was received in cash and what the company gave up, book value. So if a company sold an asset for cash, they received the cash, subtract the book value, that is the gain or loss. What we want to do is neutralize that gain or loss that's on the income statement, because it is really not the cash impact. When we look at this income statement on page 596, there is a gain on the sale of investments of $60,000, and there's a loss on the sale of equipment. And what we told you in class is that we always want to add back the loss. In this case, it's a loss on the sale of equipment. And we're adding back $20,000. There's also a gain. In this case, there is a gain on the sale of investments. Again, that's merely the difference between the cash they received and their basis, their book value. So we want to subtract gain on sale of investments, and that was $60,000. Put that number in brackets so there's no mistake that you're subtracting it. Add back depreciation, add back loss on sale, subtract the gain. That's what you want to remember from the income statement. The next step that I gave you to prepare the statement of cash flows was to look at the comparative balance sheet and calculate the difference between all balance sheet accounts. Just go right down the margin. Don't rewrite anything on a worksheet. Do it right in the margin, and maybe you can see it here, and I simply did it in the margin here, where I take this year versus last year. Is there an increase or decrease, and work from there. Make sure you do your math right. If it goes up, put a little plus. If it goes down, put a minus in. And then what we wanted to remember is this little chart. Current assets, current liabilities. If we have, and put over here increase, decrease, and what we wanted to remember is this. And well, what does that mean? Well, what we want to do in the operating activities section of the statement of cash flows is to make adjustments to net income for changes in operating current assets and operating current liabilities. So in this case, if we have a current asset that increases, we want to subtract it from net income. This little chart here indicates to you how to make adjustments to net income for these changes. So if we look at the very first item on the balance sheet, and what I suggest we do is you work your way down the comparative balance sheet. The first asset you see is cash and cash equivalents. Now, you ignore that for now because that is the change that you ultimately want to reconcile to at the very bottom of the statement of cash flows. In this particular problem, the cash and cash equivalents was $40,000 last year, and this year was $61,000. Cash increased by $21,000. Ultimately, when we're all done with all three sections of this statement of cash flows, we want to see an increase of $21,000. That's how you know you got it right. We're going to ignore that right now. So the next asset that's listed there is what? Accounts receivable. Well, what happened to accounts receivable? It went from 530 to 710. It increased by $180,000. Accounts receivable is a current asset. In this situation, what happened? It increased. We're going to subtract it from net income. So accounts receivable increased. I'll put a little positive arrow up. $180,000. Going to subtract it from net income. The next item we have on the balance sheet is inventory. Inventory goes from 860 to 848. It decreases. We have a current asset that decreases. We're going to add it back to net income. So we're going to call this inventory. Little arrow going down. I'm going to add that in. Add the difference of $12. We work our way down again. Again, we're looking at current assets and current liabilities. Prepaid expenses goes from $5,000 to $10,000. Again, that's an increase. A current asset that increases, we're going to subtract it. PPD, and again, we said that that went up. We're going to subtract $5,000 there from net income. Looking at the balance sheet and the asset section, those are the only current items we have. Let's look at liabilities. Current liabilities. Accounts payable goes from $670 to $970. Change of $300,000. An increase of $300,000. That is a current liability that increases. We're going to add it in. Accounts payable, increase, we're going to add $300,000. I'm running out of room, I apologize for that. We have a decrease in account accrued liabilities. That's the next item. It goes from $82,000 to $65,000, $17,000 decrease. A/L, decrease. A current liability that decreases, we're going to subtract it. Subtract the difference of 17. Again, put it in brackets. Other items in current liabilities. We have income taxes payable. Income tax payable goes from $80,000 to $95,000. That's an increase of $15,000. A current liability that increases, we're going to add that difference. We have income tax payable, IT payable, $15,000. We're going to add that in. $15,000. Now, I took a lot of room up here at the beginning, so I ran out of room. But again, this is making the adjustment from net income, which is calculated on the basis of accrual basis method of accounting, and we're arriving at what? Cash flows from operating activities. If we do all this math, the first section, We come up with $350,000, and what is that? Cash flows from operating activities. That's a positive number. You want to remember that. So we've accounted for all the changes in current assets and current liabilities. So that means we go to step number 3. And step number 3 indicates that we are going to take the changes in long-term items, long-term assets and long-term liabilities, and they're going to go to either one of two places. They're going to go to either the cash flows from investing activities or cash flows from financing activities. So let's take a look at that. And we'll erase this information here. And this is also a section where we need to pay attention to the additional information, as the additional information has an impact here. And again, the first section we're going to look at is cash flows from what? Investing activities. Now let's remember what those tend to be. Investing activities is where a company can invest in itself and when it can invest in other companies. So let's take a look at the balance sheet. Again, work our way down because we ultimately want to account for the change in all balance sheet accounts somewhere on our statement of cash flows. Going back to the comparative balance sheet, we have that whole current asset section, which we have already dealt with. The next one we come to is property, plant, and equipment. Now, they don't tell us anywhere in here if they invested in anything, so we have to look at that T account. Property, plant, and equipment, PP&E, right? We need to look at the beginning balance and the ending balance, account for any sales of assets to see if there are any purchases. And again, that equipment account has a beginning balance of $2,600. And it has an ending balance of how much? Of $3,170. Again, this comes right off of the comparative balance sheet that's given to you in the problem. But you know, by reading the additional information, specifically item C, that the company sold some equipment. Item C, equipment was sold during this year for $70,000. We're going to get to that in a minute. The equipment had a cost of $130,000. When they sold that equipment, they did what? They credited the account for $130,000. That was the sale. Brought the balance down to $2,470. Preliminary balance, $2,470. Now we can look at this and see what happened. Was there a purchase? I'll put a P next to it. Of course. How much? $700. The only way you go from $2,470 to $3,170 is by having a debit in that account. Purchase of equipment. What was the journal entry likely? Debit, property, plant, and equipment, credit to cash. So the company invested $700,000 in equipment. Let's call it what? Purchase of equipment, right? Purchase equipment. $700,000. Brackets, right? Because it was a cash outflow. Debit, property, plant, and equipment, credit cash. Let's go back to that item C again. Equipment was sold during this year for $70,000. There's a cash flow right there. The company received $70,000 in cash on the sale of an asset. Debit cash, credit, you know, all those other things associated with the sale. But we know we had proceeds, sale of equipment. How much? $70,000. Positive number. Again, let's go to the balance sheet, work our way down. We looked at property, plant, and equipment. Accumulated depreciation. We looked at that account. because we had to find depreciation expense. What's the next account? Long-term investments. Okay, so we should look at that account. Why? Maybe they bought something. Let's take a look at it. Long-term investments. Beginning balance, 110. Ending balance, what? 60. Okay? Went down. Need to read the additional information. The additional information that relates to this account is item D. Long-term investments were sold during the year for $110,000 cash. These investments had a cost of $50,000 when purchased. So remember, when they sell an asset, they need to record the cash, and they also need to remove the old asset. When they remove this asset, these investments had a cost of $50,000. They had a credit here for the sale of $60,000. Brought the balance down to 60. Did they buy any new investments? Well, let's look at it. Had a beginning balance of 110. They sold something for 50, brought the balance down to 60. The ending balance is 60. No purchases. They did not purchase any new equipment. Investments. Always look at that account just in case. So there is no purchase of investments, right? Zero. You don't have to list it there. I did it because I want you to make sure you look at it. Now, remember, they sold some investments, right? Again, what did they say? Item D, long-term investments were sold during the year for $110,000, right? Proceeds. Proceeds. Sale of investments. They received cash of how much? 110. They received cash of $110,000. Cash inflow. Again, you're working your way down the balance sheet, accounting for the changes in everything. That was long-term investments. What's the next one? Loans to subsidiaries. Okay, it's kind of disguised here a little bit. What does that mean? What is a subsidiary? A subsidiary is a company that another company owns. So this company, Lomax, owns another company. It's a subsidiary. It's just like an investment. Well, what happened to that account? That account went from $170,000 to $214,000. They loaned additional money to that subsidiary. Well, what does that mean? Well, the account went up, didn't it? Loans to subsidiaries went up by $44,000. So they debited that account. What did they credit? Cash. They gave additional money. They gave additional loans to that company of $44,000. That's a cash outflow. Loan to subsidiary, right? How much? 44. In brackets, right? Cash went out. Those are all the investing activities. We have a net balance here of 564. In brackets, right? A negative 564, which represents what? Cash used, right? Cash used in investing activities. That's the second section. What's the third section? The third section is cash flows from financing activities. So let's erase this and take a look at that section. Once again, you're working your way down the comparative balance sheet, accounting for the changes in all accounts. We looked at all the assets. We've accounted for the changes in all those. Let's go to the liabilities section. Current liabilities. We dealt with all those. Accounts payable, accrued liabilities, income taxes payable. What's the next one? Bonds payable. Okay, so this is cash flow from what? Financing activities. Bonds payable. Again, always read the additional information, because we want to look at that account. Bonds payable. It's a liability account. Additional information that's relevant here is what? Item B. Bonds with a principal balance of $350 were repaid during the year. Okay, repaid. Let's look at that account. Beginning balance, $600,000. Ending balance, $820. Again, that information comes right off of the comparative balance sheet, which is given to you in the textbook. So how did we go from 600 to 820? Well, you would initially think, what? That there was a $220,000 increase in bonds payable. You'd be wrong. Why? Because of that additional information. They told us that there was a repayment, right? Of how much? $350,000. Brought that balance to where? Brought it to $250. New bonds, right? $570. He issued additional bonds. So if you read in the chapter talks about some GAAP requirements that we're supposed to use the gross method, not the net method, when it comes to cash flows. So here we're specifically told that the company repaid the bonds of $350. We need to report that. Isn't that relevant information? So we're going to show here payment on bonds, because it's relevant. $350, right? Cash outflow. But we're also going to show proceeds from bonds of how much? $570. Isn't that relevant? Because that $350 payment may have occurred when? Maybe in April, right? We don't know. They didn't tell us. And this new bonds may have occurred when? Maybe in November. Two separate events that need to be disclosed to who? The reader of the financial statements, right? It's relevant information. It shows a payment of $350, then new bonds of $570. We need to show both pieces. Let's continue on. The balance sheet. Next item, common stock. Common stock goes from $1,650,000 to $1,740,000. Common stock goes up. They must have issued some additional shares of common stock. What's that transaction? Well, you remember from financial accounting, one of the first transactions you learned. Company issues common stock for cash. They receive cash, they give out additional common stock. Debit cash, credit common stock. That's an inflow of cash. I'm going to call this proceeds from common stock. Cash coming in, $90,000. Next account on the balance sheet is called retained earnings. Okay. Let's read additional information. Item A, the company declared and paid a cash dividend this year. Period. They don't tell how much. As a matter of fact, I think you always need to try to see if there were any dividends paid. How do we do that? We need to look at the retained earnings account, don't we? What happened with retained earnings? Beginning balance in retained earnings of what? $478. Add what? Net income from the income statement, $170. Retained earnings available for distribution to stockholders, $648, right? Because isn't that what retained earnings is? Undistributed net income, undistributed accumulated net income. Again, from the balance sheet, ending retained earnings, How much? 573. Were there any dividends paid? Well, in order to go from 648 to 573, they must have paid some dividends. How much? $75,000, right? Remember the journal entry. Debit dividends, credit cash. A cash outflow. Dividends paid. $75,000 negative number. What's going on here? Cash flow provided from what? Financing activities? 235, right? Positives versus negatives. So we've looked at the three sections of the statement of cash flows. Cash flows from operating activities, cash flows from investing activities, and finally, cash flows from financing activities. We need to look at the summary of all those, right? So let's do that. Again, we can't put the whole problem up here on the board at once, so we don't really see it. But if we summarize it, cash flow from operating activities, we had a positive 350. Cash flows from what? Investing activities. What happened there? Negative 564. That was used. And then lastly, cash flows from what? Financing activities. And we had what? 235. Net cash what? Provided $21,000. 350 minus 564 plus 235. It's a positive 21. What was my beginning cash, right? Where does that come? From the balance sheet. Go back to the comparative balance sheet. Look at the beginning balance and you can see $40,000. 21 plus 40 is 61. That should be my what? Ending cash, right? Should be the ending balance of cash and cash equivalents at the end of the year. It's 61. I look at the problem. That's exactly what it is. $61,000. That's how you know you got it right, when it balances. Okay? So that is problem number 14, Lomax Company from Brewer 7th edition. I hope that helps. I apologize, it might have been a little sloppy. Take care.